A market crash is coming, like we saw in 2008 or March 2020. It is absolutely inevitable. Now, I don't know when that will occur, but today I'll show you why you don't have to live in terror about the moment when it does. I'll break down why you should always be prepared for market downturns, why investing at all-time highs isn't as risky as you may think, and the biggest reason that most investors lose money. I'll review a couple of ways to actually benefit from a down market or a pullback. And my goal today, if this video can help even one person stick to their investment plan rather than panic trading or cashing out, then I've done my job. Now, lately, there's been a lot of fear around the economy and the state of the world, and investor anxiety has been through the roof, which is understandable. As of now, the S&P 500 is down 12% from its February high, and it's actually rallied back recently from previous lows on some potentially good news about trade wars and the Federal Reserve. But that doesn't mean that the downturn is over, and another one could certainly be on the way. And if you're watching this years down the road, all of these downturns and rallies will occur again. The other downturn, the next one, will arrive at some point, whether sooner or later. Now, I am not trying to minimize your anxiety around losing money in your portfolio. I feel like a lot of the advice to stay the course just glosses over the true emotional impacts of a downturn. So sure, you're going to feel anxious, worried, maybe even angry when you see what's happening. And there's nothing I can say to take those emotions away. Like they say, feel the feels, right? But as an investor, you do need to understand how market pullbacks have worked historically and what typically follows. So, let me tell you a story of two major market crashes and the lessons we learned from them. Since 1928, way back, the U.S. stock market has had an annualized return of more than 10%. So that means if your grandmother or great-grandmother had invested just $1 back then and left it alone, by the end of 2024, that one little lonely dollar would have grown to over $10,000. Now, even more impressive, since 2009, markets have compounded at about 14% a year. Now, those results didn't come without volatility. There have been plenty of sharp declines that have tested investors' patience and discipline since 2009. And emotional reactions to downturns, that's one of the main reasons people lose money. Now, I want to show you an interesting chart. I think it's interesting. I like to remind clients that the market is up much more often than it's down, even though it may not feel that way to you. Now, here are the up years in green versus the down years in red for the S&P 500 since 1928. And even though some of those down years were pretty big, the up years more than made up for those. Since 1928, markets have been up nearly 75% of the time annually, despite the average decline in down years being 16%. Now, looking at more recent history, from 1980 through 2024, the average intra-year drawdown was 14%, while the index has produced an average gain of 13%. In other words, markets have shown positive returns, despite some pretty big intra-year declines. And even in years where the market ended strong, there was often a significant drop sometime during the year. Now let's take something in very recent memory, 2023. The S&P finished 16% higher, but there were two significant drawdowns that year. Early in the year, we had a pullback of about 9%, and then between July and November 2023, we had a correction of almost 11%. And those definitely scared people, just like now. So it's easy to forget, but we had the banking crisis in early 2023. Seems like ancient history now, but people thought the economy might melt down, but it all came back, right? From 2000 to 2023, the market dropped 19% or more in 8 of those 24 years. Those big pullbacks are far more common than most people realize. So here's an example. If you retired in 2000 with a $1 million S&P 500 portfolio, you would have seen your portfolio value decline by $200,000 or more 6 times. Now that's painful, but it's actually pretty normal. And I am completely comfortable guaranteeing you another big crash or downturn is coming. I don't know when, but over a retirement that can last more than 30 years, you'll likely see 8 to 10 major downturns. Each one is going to feel scary, not because you're a bad investor or you've made mistakes, but because you're human. And what happens, especially in retirement, is that fear leads people to sell at the worst times. I've seen it with friends, family members, clients. And then what happens is that getting back into the market becomes more difficult. And some people sit on the sidelines for years, much to their regret. And why is that? Because they're waiting for the market to get back to normal, which it never does, by the way. Also, even when markets are up, a lot of people perceive that they're down just because the news media is constantly reporting what's bad and negative, and that's what sinks into our brains. So take the example of Peter Lynch, the famous Fidelity Magellan manager. He averaged 29% a year from 1977 through 1990, more than double what the S&P earned during that time. Now there's a look at the chart. Now, that's pretty amazing, right? But the average investor in the Magellan Fund lost money because they bought high and sold low. And I know this sounds familiar, right? You want to do the opposite, buy low and sell high. But you can use a market downturn to your advantage in that sense by adjusting your investment allocation if you need to. Now, just be aware, if the market does keep rising after you rebalance, you may underperform, and that's okay. You're not trying to swing for the fences all the time. Your goal should not be to make as much money as possible, because that's not incorporating risk. And that might not be how you're accustomed to thinking about the market. But the return that you're aiming for should be keyed into what you need in retirement and not some random and vague goal like make a lot of money. You know, in fact, that is not even a serious retirement investing goal. Hey, if you want more ETF tips for your retirement portfolio, here's my free guide to ETF income generation. Now, the idea here is to build a strong, diversified retirement portfolio with the right inputs, okay? And that's why I've put together this ETF guide to help you grow and protect your money. From dividend growth and low volatility ETFs to international exposure and inflation hedges, this guide covers it all for you. So whether you're looking for steady income or long-term growth, these ETFs can support your retirement goals. So if you're ready to level up your portfolio, check out the full guide. Link is in the description. Now here's another tip. During market downturns, consider a Roth conversion. If your traditional IRA drops in value, converting at that point when the markets are low means paying taxes on a lower amount and gaining tax-free growth later. But that's not the same as timing the markets. Don't get that wrong. And I know all the traders will tell you that it's possible to beat the market. I have no idea why that's anybody's financial goal. It doesn't even make sense. It's ridiculous, kind of what I was talking about before. Your return should be keyed to what you need. Sometime I'll do a video explaining in detail why trying to beat the market is just so silly. But market emotions can run hot when everyone feels either euphoric or hopeless. That means a reversal is often near. Now, you may have seen this chart before. It's the emotional cycle of investing. It's a proven phenomenon, and over time, it's repeated time and time again. Opportunity strikes just when you're most discourage. In reality, markets hit all-time highs more than you think and more often than it feels like. Here's some data from JP Morgan. Since 1950, about 7% of trading days were all-time highs, and investing on those days has historically led to even better returns. You're not setting yourself up for a crash, right? I want to just pause here for a second. Before I became a financial advisor, I worked with the late Bill O'Neill at Investors Business Daily for 10 years. I even helped edit the last version of his book, How to Make Money in Stocks. And one of the things Bill said that I've never forgotten, for the market to reach a new high, it has to go through a previous new high, right? So it's a series of new highs. And a quick glance at the S&P chart since 2009 shows you that. So no, I am not saying go all in at the top just because you can, but it's not necessarily a signal not to buy when you're building a portfolio designed for the long term. If you're nearing retirement or in retirement, you want to balance your income needs with growth potential. Very important. Build something you can hold through the storm so you can enjoy retirement with less financial stress. And if you want to learn more about how to do that, leave a question in the comments. I am happy to help. Thanks for watching, and I'll see you next time.